Hey everyone, this is Mike Bonn with the Cash Flow Company. Today we're going to go over DSCR interest-only products, and we're going to compare it to an amortized loan, why you should look at it, the flexibility of it, how it helps you with cash flow, and even helps you qualify for more properties. So quickly, what is interest-only when we're talking about DSCR? DSCR interest-only or any kind of interest-only loan product means all you're doing for a certain amount of years is paying the interest that is owed on the loan. Principal never goes down. Amortized loans are where you pay a little bit of principal and a lot of interest. Here we're just talking about interest only. In this market where rates are a little bit higher, interest only is a great product, like I said, to get you into more properties, keep your cash flow up, because on interest only, you can still pay a little bit more on the principal if you'd like to. It gives you the flexibility. So that's the beauty. One of the beauties of interest only loans, it gives you flexibility. You have the choice every month just to pay the interest only or pay a little bit down. One thing to remember when you're paying a little bit down is every year they have prepayments on these DSCR loans for the first 3 to 5 years. So every year you're capped at about 20% through that prepayment period that you can't pay over 20% of the principal. Usually never an issue because we're talking about, maybe making an extra couple $100 in payments to keep that down for flexibility if you want it. Let's look at an example of an interest only and an amortized loan just to see how it helps you qualify and actually also helps you with your cash flow. A few things we're going to go base this off of is loan amount. For this example, we're going to use a loan amount of $200K. And another factor that we're going to look at is rents. Rents on this property are going to equal $1,700. Lastly, what you're going to find in this market that might come down again is the DSCR ratios. Most DSCR ratios right now for the better rates are 1.1. So we're going to use a DSCR ratio. And if you don't know what that is, we have some other videos that go over how do you calculate it. But a DSCR ratio of 1.1, what that means is your rents have to be 10% higher than what your expenses are. So we want to see a cash flow in property when it gets down to it. So let's look at an example. Let's look at a interest only. So I'm going to use IO as interest only, rate of 8.25%. And we're going to look at a traditional AM loan. So an amortized loan, that means you're paying principal plus interest of 8%. And what you'll find in most cases in this market, the interest only will be a little bit higher as far as rate than your amortized loan. So what does a payment look like for the interest only at 8.25? Remember our loan amount was $200,000. So what we do is take $200,000 times the 8.25%. That gives us an annual interest divided by 12, and we get a payment of $1,375. So on interest only, it's $1,375 for the interest only. That is your payment to the mortgage company. On an 8% amortized loan, now it's $1,468. And the reason it's higher is because you're paying a little bit of principal along with the interest. Even though the interest rate is lower on an amortized than the interest only, since you're paying a little bit of principal every month, your payments are going to be a little bit higher. So this is your payments for interest only amortized. You have to add with the DSCR, you have to add taxes, insurance, HOA, and flood. In this case, just for simplicity, let's just say those equal $150. Because when we're figuring out if this qualifies, we have to have not only the mortgage payment, but we have to have those 4 items to come up with a grand total for the month. So a total for the month on this property is $1,525. And for this one, it's $1,618. So this is your monthly payment for this property based on interest-only loan or amortization. You see that there's a little bit more flexibility. There's a little bit more cash flow for the interest-only. Yes, you're not paying it down, but when rates are high, sometimes just to cash flow, to make sure you qualify, interest-only is a great choice. So now we have our payments. We still have one more step just to make sure we qualify on this property using the DSCR, and that is timesing this number, your expense, times your DSCR ratio. Your DSCR ratio, like I said, could be 1, it could be 1.1, 1.25. Your lender will give you that information, In this market, most people are using 1.1 as the minimum. So to calculate this ratio, we're going to take our payment, we're going to times it by 1.1 in each case. So we're going to take your payment and we're going to times it by our DSCR ratio of 1.1. So in this case, on our interest-only loan, we're going to take the $1,525. We're going to times it by 1.1, and we're going to come up with a number of $1,677.50. And we're going to compare this number to the rents. And to qualify, your DSCR ratio, the 1.1 times the 1,525, has to be less than your rents. So we got the interest only. Now let's look at the amortization, the AM loan. And we're going to take the 1,618 times the 1.1. And what we're going to find is our number now is $1,779.80. So what do we know based on these numbers? Interest only qualifies because it's less than. So we could take out this loan and it qualifies by the interest only. Using the amortized, even though it's a lower interest rate, it does not qualify because the $1,779 is larger than your current rents. Just remember, when you're looking at rents and you're talking about rents, these rents are what's happening in the market. And your appraiser, when he comes out and does an appraisal, he's going to do a survey. They're going to check rents in the neighborhood, and they're going to verify that your rents are within the market. So you can't just come up with a number, give it to the lender just because you want to qualify. In this case, there's going to be rent schedules done, rents checked, just to make sure this number is accurate with the neighborhood. With DSCR interest-only loans, it's going to give you flexibility. Remember, you're going to be able to make that interest-only payment if you want, or if you want to add a little bit of money and knock down the principal. Every month you can make that decision. It also helps you qualify. In this case, you could see that a interest-only, even though the rate was higher, helps you qualify for different loans where the amortization product does not. Interest-only is a great product for this current market, in any market. Interest-only loans come where you can have the period of 5 years that it's interest-only, 7 years, or 10 years. So you get to pick what market or what kind of period you want the interest-only. If you have a question, if you want to run through some DSCR numbers, reach out to us, thecashflowcompany.com. You can contact us. We'll get right back to you. We can run the numbers for you. We'll see if it's a better fit for you to go interest-only or get a better rate and go with the amortized loan. If you have any other questions about DSCR or other investment loans, you can email me directly at Mike@thecashflowcompany, and we'll catch you on the next video.